Business Authority.
23 seconds away from the opening bell in New York City. From Washington, D.C. this morning, good morning to you all. As we count you down to the opening bell, here's a flavour of the price action. Equity futures positive, a third of 1%. A lift following the economic data we got about an hour ago on the Nasdaq, up 0.6%. There is your opening bell. Switch on the board and get to the bond market. Take a look at this in the bond market. Yields shaping up as follows. Unchanged, 338.87. But in the FX market, what a move. 110.50 on euro dollar, a new intraday high for the year on euro dollar, 110.57. The Y is in the economic data of 60 minutes ago. Jobless claims a little bit higher than anticipated. PPI a little bit softer than anticipated. If you wanted a reason or two for the Fed to back away, a bit of softening of the labour market, a bit of a sign of disinflationary trends taking hold. You got both of them about an hour ago. How much weight you put on them is for you to decide. So there you go. There's the opening bell. Let's get straight into the market. 30 seconds into the session, your equity market shaping up as follows on the S&P 500, firmer by 0.25% at least. The Nasdaq up by about 0.6% this morning.
Yeah, I'm focused on the airlines this morning when you take a look at what is moving, just simply because we did get those Delta earnings earlier, and they were better than expected when it comes to second quarter projections, and really that seems to be the focus. And you can see after the initial pop, the shares are actually lower, which really is interesting to me, given that we saw them up about 3% half a second ago. And this comes as there is this real tension between people booking so many flights and paying a ton for them, making good margins and expected to, and yet what do you get with consumer discretionaries if you do get some sort of slowdown, as we see reflected in a tick up in layoffs and a tick up in what the pressures are for the economy. You can see, though, that there still are some gains being held on to American Airlines, up about 0.8%, and United up about 0.8% as well. There are other stocks that are moving, but you know what I find interesting?
Sure.
Financials aren't moving much. They're pretty much unchanged, maybe up a little bit ahead of the earnings tomorrow. And so I'm really trying to see whether there's going to be some sort of pre-look or gaming out of what we're going to get tomorrow.
I can't wait to go through the numbers from the financials, Tom. Not just because I think a lot of people are interested because of the shock of the last month. I'm actually looking to the big names to see if there are any positives there for them and how embarrassed they might be of some of the gains they've got over the last 30 days from some of the tension we've seen with the smaller players, the regionals.
What I'm going to watch is what they genetically do, like lemmings off a cliff. Oops, things are uncertain. We need to cut costs, and I'm really interested in the cut cost vision. There'll be lots of verbiage to avoid that language, but I really wonder how tight the ship's going to be at some of these major players.
One question I've had, Tom, over the last couple of weeks, it was too soon for the Federal Reserve to change its outlook. Its outlook in the summary of economic projections was largely unchanged at its last meeting from the meeting previous to that 2 meetings ago when they last delivered their quarterly outlook. If it was too soon for them, is it too soon for the C-suite to change their outlook in the financials, given the shock we've had, Lisa, over the last 4 weeks?
They'll be out front of the Fed.
I would agree, but I also think we've heard some anecdotal discussions about how credit card spending has come down. We've heard anecdotal conversations about how banks themselves are increasing their credit standards. How much do they increase their credit standards? Are they reducing what they lend? Are they increasing some of the credit loss provisions? What are they doing with some of the loans still hanging out on their books, say like Twitter? I mean, I'm just curious what they indicate as they deliver earnings.
This industry group, Tom, has said repeatedly, quarter after quarter, for a couple of years now, that the consumer's really resilient. It's got this massive cushion, a big pool of savings, and let's see if we've taken a big chip away at that in the last quarter.
Some of the uncertainty here that we have into the second quarter, dare I say, do we have a vision to Labor Day? I doubt it. Someone who does have a vision to Labor Day is Kristen Bitterly, head of North America Investments at Citigroup. How do you rewrite the year-end outlook, Kristen, right now? What is new in the Citigroup outlook?
You know what I think is really interesting, Tom? We have been one of the few firms that has not rewritten our outlook once or multiple times in 2023. We started this year with the belief that we would see a recession and that we would see an earnings contraction of upwards of about 10%. And so that is something that's based on not what we've seen year to date, but actually all of the cumulative impact of this tightening that if you look at any one individual data point, and I know you guys were talking about this a little bit earlier, I think you can start to explain it away or to try to find a narrative. But when you look at all of the leading indicators and all of the data points that we have seen that have shown that we are seeing a decline in economic growth, that still keeps us in our defensive positioning, which is where we started the year and where we're holding on.
Right. Well, you've got economists looking for some form of rate stability, or dare I say, a set of rate increases as well. How do equities compete with the Citigroup outlook on what short rates will do?
And this is, I think, the most interesting story that we have seen is the resiliency, or I should say the quote-unquote resiliency of equity markets. All the volatility has been in the rates market, as you well know, and the repricing of monetary policy numerous times. I think when we break down, though, the story within the equity markets, it is interesting because 92% of the gains that we've seen are really attributed to 7 companies, of which about a quarter of that is Apple. When we break down what's been happening under the surface, just looking at Q4 earnings of last year as a little bit of a forecast, Q4 earnings, we had 7 sectors already in profits recessions, and that was up from 4 sectors actually in Q3. And so we're already starting to see some breaks under the surface in terms of impacts on profitability, even though the index is telling us a much different story.
So, Kristen, with that in mind, going into earnings season, the big banks on deck reporting tomorrow, starting with JP Morgan and others. Just how low is the bar? How low has that bar been set going into earnings season?
I think the bar is actually pretty low. So obviously there's not a lot of expectation here in Q2 earnings. But I think what you guys were just talking about prior to this segment becomes critically important. For bank earnings, and especially when we're looking at the large banks, I do think that when you look at some of the stock price performance already and what's been priced in, we know what's going to happen in terms of whether you're looking at pressures within investment banking, deal-making revenues, the limited activity in equity IPOs. And so I think a lot of the discussion is really going to be around what is the forward guidance and what is really the environment that we're talking about, not from a liquidity standpoint, not from a profitability standpoint, but actually about a credit creation and credit availability standpoint, which obviously has important implications for the economy.
So how are you going to use this, Kristen? I mean, we talk about how this is going to be the key data point possibly of the week. Forget CPI, forget PPI, forget jobless claims. It's going to be what JP Morgan's Jamie Dimon has to say about what he's seeing with respect to lending conditions. From your vantage point, how does that change what you do Monday?
So on Monday, I don't think there's a material change in terms of our portfolios because what is going to happen ultimately is we believe that, again, this is not an additive effect of all of these different indicators. There's actually a multiplier effect, and there's a little bit of a cycle that we will see. So this idea of us being defensively positioned, and one of the things that I have to mention is it doesn't mean that we're sitting out on the sidelines. It just means that our overweights in terms of fixed income relative to equities, we are leaning into quality, we're leaning into more conservative positioning within our portfolio. What is really going to turn any type of appetite to be long risk assets? It's going to be ultimately the Fed's trajectory, and it's going to be the signs, particularly what we're seeing, jobless claims, not just initial ones, but continuing ones. Those are really the signposts for us in terms of whether we're going to make material changes within our portfolio, and that can happen relatively quickly given that cumulative impact of all of those indicators that I just mentioned.
Kristen, when people talk about being defensive and having an allocation perhaps have more heavily weighted to duration, I wonder if that still works, because last year we saw the death of 60-40. This year we see the resurrection of 60-40, maybe, depending on the month. I mean, from your vantage point, are we back to reasserting this sort of ballast of bonds offsetting stocks?
I would hope so. But I think the interesting thing, kind of going back to the common equity markets and then the volatility that we've seen in rates markets, when you look at all of the inflows, we could use the proxy, the ETF inflows that we saw throughout the month of March. When you look at those inflows, and there was about 30 billion of inflows, 28 billion of that was in fixed income. And where was it concentrated? It was concentrated ultra short, and then to a certain extent, a little bit longer in duration. And you really didn't see a lot of activity within that belly of the curve. And so I think right now, when you're looking from a flow perspective, there still is, the number one question that we get is, why don't I just hide out in that short end of the curve in cash and kind of wait for some of this future volatility? So I think some of that we're going to see normalize over the next couple of months, but that volatility that we're seeing on the short end is certainly still there.
Kristen, last question from us. Favorite idea right now? Kristen, what is it that you're advocating for with clients at the moment?
Favorite idea is to play a little bit of defense and actually to take advantage of the low volatility environment that we've seen, that if you are someone who's fully invested, you're not trying to time the market, taking advantage of some of the hedges that are available because of this muted volatility is a way for you to actually stay invested and mitigate some of this volatility that we could see and weather the storm in what could be choppy markets over the next couple of months.
Kristen, thank you. Kristen Bidley there of Citi. Equities right now about 9 minutes into the session on the S&P 500 shaping up as follows. We are just about positive by 1/3%, a lift in the Nasdaq. Is tech defense, Lisa? We've asked that a few times, haven't we? On the Nasdaq up 0.9%.
It wasn't, and now it is. It depends on who you ask. I mean, basically, Tom is trying to create a new need for another iPhone.
Triple leveraged all cash.
Triple leveraged all iPhone, right? I mean, but this is really the issue, right? What does defensive mean at a time when you have companies that are flush with cash, but they also are interest rate sensitive and have gotten their valuations blown up over the past couple of years?
33 years ago, I went through the same thing. Everybody has these narratives that center around long-term securities theory. You need to be diversified in a well-balanced portfolio. All these themes. With great respect, they got to go out there and do this. And the clients, the trust funds, the institutions go, yeah, but.
How did that work out last year?
There's massive yeah, but.
Well, so far so good in 2023. There is a band setting up behind us here at the IMF Global Headquarters. Jim Bianco of Bianco Research was with us about 20 minutes ago. He said, I didn't get a chance to say it. Pinged me a message on the Bloomberg. He said, the drums over your shoulder on stage have a Live Aid look. Can you sing Radio Gaga for us as well? Would you mind?
No, I can't do that. It's not, I could do a Willie Nelson thing, but I don't think crazy.
Nice.
This is seriously, this is Jerome and the dot plots, and what's so great is after the impact of his speech a few days ago,
Queen.
Goolsbee is flying in to play drums.
Not Lady Gaga.
Okay,
oh, Bramo, what was that? What was that?
Well, she's a sophisticated on this stuff.
Come on, thank you.
All right, you've got 30 seconds just to sit there.
These guys, they gotta relax.
I want to drown. Please rescue.
They've got to relax. So this is what you get. Goolsbee's playing drums, and I don't know who else is playing.
Jay and the dot plot.
Jay and the dot plot.
I love that. I love that. Raghu Rajan, the former IMF chief economist, former leader of the Indian Central Bank, now of the University of Chicago Booth School.
Rude again.
Joins us next.
And that's what happens when you push the show into an extra hour. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Applications for U.S. unemployment benefits rose for the first time in 3 weeks, suggesting some more softening in the labor market. Initial jobless claims increased by 11,000 to 239,000 last week. California accounted for more than a third of the increase. Another missile launch from North Korea. A suspected intercontinental ballistic missile was fired toward waters off Japan's northern island of Hokkaido. That prompted a brief warning for residents to take shelter from the threat. South Korea says it's possible that North Korea may have tested a new type of solid fuel missile. There's a report on the alleged leaker of those U.S. intelligence secrets. According to the Washington Post, it's a young gun enthusiast who worked on a military base and shared the classified documents with a group on Discord. It's an online platform used by gamers. He was known as OG and told the group he spent some time inside a secure facility. Discord says it's cooperating with authorities. JP Morgan is still reacting to last year's nickel crisis. Wall Street's biggest player in metals has cut dozens of base metals clients and slashed bankers' bonuses. The bank was the biggest counterparty of the Chinese company at the center of the nickel short squeeze on the London Metal Exchange. And Apple is accelerating that move beyond China when it comes to manufacturing. Bloomberg's learned that more than 7 billion of iPhones were assembled in India in the last year. Now that's tripling production. Apple now makes 7% of its iPhones in India. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
not really seen evidence at this stage suggesting a contraction in credit.
We have seen a couple of data releases that have shown a certain amount of tightening in credit underwriting standards, as well as in the overall level of credit.
You're being kind, because I think she said she saw no evidence of lending contracting, and you've said we do.
Yeah, absolutely. There is certainly evidence in the data of some contraction in lending and some tightening of lending standards.
Some daylight between Janet Yellen, the US Treasury Secretary, and Tobias Adrian, the IMF Director of Monetary and Capital Markets, earlier on this morning. Some daylight between the administration, the Treasury Secretary, and the International Monetary Fund. I think we've all seen that evidence of lending contracting based on some of the data we got Friday afternoon from the Federal Reserve, Tom, and yet the Treasury Secretary taking a different look on things at the moment, at least.
I see the daylight through the BTMM screen on the Bloomberg. It's real simple. Watch short rates in the old school 3-month LIBOR and the rest. What competition that is for flows, and you may not get the drama of a number of weeks and months ago in the banking system, failed marketing plans and that, but you're going to get just a persistent challenge is a whole world gets used to the interest rates we studied decades ago.
Welcome to the program this morning. If you are just tuning in on TV and radio, an extended edition of Bloomberg Surveillance. Allow me to get you up to speed on some of the price action in the market this morning. The opening bell about 17 minutes ago. Equities with a lift at the moment on the S&P, up 1/3%. Yields a little bit lower by a basis point or two on a 10-year. The standout, a new intraday high for the year on euro dollar. 110.50 plus, now 110.65, positive 6 or 7/10%. 1 hour and 17 minutes ago, we had some data in America showing jobless claims, Tom, a little bit higher than expected. PPI, the biggest drop we've seen on factory gate inflation going back to the beginning of the pandemic, and arguably that's what the Fed is shooting for. And this is the objective, and subsides this morning at least.
And dynamics there with wage growth coming in, and I said a halving, somebody criticized me for that. Maybe it's not a halving, but the disinflation of wages, the disinflation of price, it's tangible.
And so far so good. The equity market likes what it sees based on the last hour or so. We'll see if this sticks.
Bramo had that.
We saw some moves yesterday that didn't hold, particularly in the bond market.
Absolutely. And people sort of parsing beneath the surface, and maybe it doesn't look as soft as people originally thought.
Right now, this is a joy. As you well know, there were 142 books written on the crisis of 07, 08, 09, and singularly definitive was fault lines as we face new fault lines now. The author was Raghuram Rajan of the University of Chicago Booth School, and his follow-on book, The Third Pillar, was my book of the summer ages ago. The former head of the Indian Central Bank joins us this morning, and we could go for 2 hours, Raghu, and we don't have it because I think you're heading for the airport. So let's get right to it right now. Olivier Blanchard is looking at dynamics of our start and growth. The developed world's looking at this. The emerging market world and their fragilities are looking at it right now. How close are we to an instability of where we need to be versus the growth rate we hope to see?
Well, we have still a economy in the U.S. which is not landing, right? It's chugging along. The first quarter looks pretty good. The problem is more with the medium term. What happens when all the stimulus plays through? What happens when the stimulus from the Inflation Reduction Act plays through? Do we slow down? And what you're seeing in many emerging markets is a lot of damage done by the pandemic, which is also going to hold them back going forward in terms of consumption, for example. The lower middle class, deeply hurt during the pandemic, slowly recovering, but it's going to take time. And of course, we've got all these overheads, such as the tariffs, the deglobalization, the conflicts, the attempt to... So in terms of longer-term growth, it doesn't look good. I think the IMF is exactly right. Longer-term growth looks a lot worse. Of course, where R-star settles after that, there are conflicting forces. The IMF says low, Larry Summers says high. My sense is low, that yes, you may get an inflation premium tacked on to the real interest rate that is equilibrium, but it's not going to go back to high levels.
Raghu, Tim from Cupertino emails in. Thanks for watching this morning, Tim. And he says, China and India, you are the #1 expert we have in the world on the dynamics of these two great nations versus a new America. Explain to us how you see 24 months out Washington, Beijing, and all of India.
Well, I would hope that we don't go down the path we're on between Washington and Beijing. That's the key relationship in the world. That is fracturing. I hope they talk more. They're not. They should. That's important for the rest of the world, because if you have to choose sides, countries will be in a very, very difficult position. Of course, there is hope that some country like India will take up the growth engine from China. That's not going to happen for a long time. India is 1/5 the size of the Chinese economy. Even if India grows at, historic China-like growth rates, which is still a ways away, and it needs to do a lot to get there. India is not going to be a substitute for China. What is important is India do what it does really well. India could be a big exporter of services. You're seeing service exports in India go through the roof. And these are things not just IT exports. These are new forms of services. For example, consulting services being produced from India. It's not just the back office of old. It's new, consultants actually facing clients. It's lawyers facing clients. That's, I think, a mode for the future. That's going to help growth across the world.
Bringing us here to the here and now. Back in 2005, you were the head of the IMF Economics Department, and you warned about a banking crisis.
Yep.
Larry Summers, at the time Treasury Secretary, called you a Luddite. Do you think that we are on the precipice of some sort of financial crisis or significant credit crunch that is underappreciated?
I think we're not over yet. How bad it gets, we will have to see. I think this problem is more systemic. We sort of putting it on a few banks, right? These are the guys who splurged, they didn't do the right thing. The fact is, when you have quantitative easing of the kind we had in the pandemic, the Federal Reserve expanding its balance sheet tremendously, what happens? Well, commercial banks also have to expand their balance sheet. They expand it by issuing uninsured demand deposits. Uninsured demand deposits went up by trillions of dollars during the pandemic, and they haven't come down. So the sources of fragility are there, right? You're bringing down reserves, but these guys still have a lot of demand deposits out there. Now, we've seen that, of course, where those deposits were invested also matters. If they were invested in long-term securities, you're seeing those losses permeate through the balance sheets of the banks. And there will be, problems going forward. The question is, as you pointed out earlier, how does this play out in terms of the credit crunch, which is coming? Are there substitutes? Does private credit, for example, pick up some of the slack from the banking system? That's the big unknown. But accidents, I think we can't say we're over.
Are credit crunches inherently disinflationary?
They are. I mean, they're going to tighten. So you could argue supply side, demand side, right? But I think the net effect is disinflationary typically. So yes, it will do the Fed's job a little for it, but the Fed doesn't know if it's coming. The Fed doesn't know how much. And right now, while the numbers look good, you're still looking at things like services inflation, which is still strong. So the Fed can't relax at this point on the inflationary front, even though, from the credit front, it probably should be a little softer.
You were really moved by your interview with Raghu's colleague, Luigi Zingales. Frame that with a professor from Booth School.
Groupthink, the fate of the Federal Reserve on both monetary policy and on regulation. Do you think that institutions like the one we're in right now this morning, the Federal Reserve, which we talk about often, still suffers from groupthink? And if you do, how on earth are we going to address that?
I think the one thing that seems to be off the table in the discussions is the role monetary policy has played in creating financial fragility, right? We've sort of put that off the table. We don't talk about it at all. And you have to believe that 3 crises in 2 decades, it has to have played some role. And to put it off the table and say, look, it's the private sector, it's the financial sector doing its stuff. They've got bad incentives. Well, that's part of the problem. That's not the entire problem. Now we're saying supervisors are also part of the problem. But what about monetary policy? What about, for example, QE? Wasn't that part of what created the fragility? That, in fact, we're seeing now. And that's why we need organizations like the IMF to start talking. They're very hesitant to complain about central banks of the industrial world because those guys have more economists than the IMF sometimes.
I hear you. Unfortunately, we're out of time, and I could talk about this all day, but it's the establishment view still dominates the conversation. And I think that this institution that we're lucky enough to sit in this morning is part of the problem on that front. It needs to make a bigger argument. Raghuram Rajan, always fantastic.
Right.
Thank you, sir.
Thank you.
Raghu, thank you. Raghu Rajan of the University of Chicago Booth School. Coming up tomorrow, an extended edition of Bloomberg Surveillance, once again from the IMF. Gerard Cassidy of RBC Capital Markets. Valdis Dombrovskis is going to be joining us from the European Commission. Mohammed Al-Arian with us in Washington. Looking forward to that conversation. From DC, this is
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, April 13th. Here are the top market stories that we're following for you at this hour. So no doom and gloom for Delta. The airline sees a strong second quarter in summer travel season, offsetting higher costs. The stock, though, loses gains and now turns negative. So where's my top line contraction? Stocks trade steady as earnings season officially kicks off with big banks tomorrow. We're going to see if revenue can keep holding up. Outlook still gloomy. The IMF only sees a minimal cut to growth this year. While clouds build, we're going to go live to the IMF meetings in D.C. to talk to Eurogroup President Pascal Donahoe. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I feel like we got through jobs. We got through CPI.
Yep.
Is earnings going to be the next hurdle? Does it not matter? I don't know.
No, we've done the macro. It's time to do the micro. It is time to stop being top down and be bottom up, because I think the earnings season is going to be really important. Maybe less so for the numbers that are delivered, Alex, but more so for the commentary that comes with it. Mm-hmm. You brought up Delta. It was your top headline. I like to see the world through the prism of the airlines and the aerospace sector. The quote from Ed Bastian today is the one that stands out for me. If there are signs of slowing, Ed says, don't look here. The airline sector is quite literally flying. The top line is flying, but like American yesterday, it's this cost angle that I think is the problem. And I think this is going to be the narrative that weaves its way once again through the earnings season. Top line's great. The economy's great. Okay, what's the but?
The but is that I feel like we've been waiting for the top line to fall. When we got the fourth quarter results, the conversation was, but you know what? When we get first quarter numbers, that top line is going to start to fall, and it has not yet, for the most part, done that.
We've been waiting for inflation to come down. We've been waiting for the economy to crack. We've been waiting for the labor market to fall apart. These things are happening much more slowly than I think people anticipated. I think the real standout story at the moment continues to be, and you saw it today here in Europe, you take a look at what is happening with the UK GDP print today, you take a look at a whole range of European stories as well, look at LVMH. The consumer is holding up much more than anybody anticipated, and that's why the top line continues to deliver. But to Alice's point, at some points, theoretically, the top line is going to tank. So that is our question of the day. When does the top line tank? Joining us now to discuss that is Bloomberg's Kriti Gupta and Edward Harrison. Kriti, when does the top line crumble? When does it tank?
You're basically asking me to make a recession call on international television, Guy. I'm not going to do it. You won't get me this time. But what I will say is look at what's priced into the markets here. They are expecting, at least from the bond market, a recession to at some point hit in the back half of the year. And you're seeing this in the earnings numbers as well. The idea that at some point there's going to be this kind of gloom and doom macroeconomic recession that you will see. But it's something that even tech companies have been forecasting, I want to say, for over a year now. This was a conversation we had back in 2021 that a recession is right around the corner, and the consumer stood steady. I think now we're talking about perhaps if the markets are talking about 2023, it might just take a little bit longer. So 2024 is now where it feels like a lot of the focus is, and by the way, where a lot of the stock market, like individual micro stocks, are starting to trade based on the guidance you're getting a year out from now.
It's like we already priced in the top line growth slowdown like in mid-2022, and now we're pricing in the recovery in 2024 without having seen the top line fall off. Edward, what do you think?
Yeah, I'd agree with everything that Kriti was saying. However, let me look at Delta as an example. I thought it's interesting because, you have revenge travel. They had at Delta the highest 10 cash sales days ever. They're above pre-pandemic levels, but their EPS was below expectations. Not only was the EPS for Q1 below expectations, but their top line was below expectations as well. And this is in a sector that is doing incredibly well. You add in the fact that we have a credit crunch that is starting to take off, and then the next question becomes, what do the banks look like? So I really want to see what the bank earnings look like, not just the big banks like JP Morgan, Goldman, Morgan Stanley, etc. I want to see what the regionals look like, because I think that's where the rubber hits the road in terms of whether or not the economy goes into a recession.
Yeah, and I take your point, Edward, about what is happening with the banking sector, because I was listening to Mike Wilson talk about this a little bit earlier on from Morgan Stanley. He was saying, I don't actually really care what happens with the bank story. What I care about is what they're going to tell us about what they're doing with credit and credit's availability, because that's going to have a wider economic impact. But to come back to Delta, Edward, I come back to this quote from Ed Bastian: if there are signs of slowing, don't look here. I hear what you're saying about revenge spending, but he's basically saying the summer is going to be strong. The consumer seems to be wanting to spend more than we all anticipated and spend for longer as well. Ed, what is that down to?
Yeah, I think, when I talk about revenge travel, I'm talking about people who were locked up during the pandemic and who want to spend more. So you can see that Delta and American should be the biggest beneficiaries of the consumer actually having the wherewithal to continue to spend. And yet we see the top line for Delta falling short of expectations. What that tells you is that there's a creeping level of expectations drift down. I thought it was interesting interesting that Kristen Bitterly from Citi in the last segment that we had, she said that in Q4, the earnings, we already had 7 sectors of the economy, 7 sectors that were in a profits recession. So what we're seeing now is a narrowing of the leadership. That should include, the airlines, travel in particular. And so then the question becomes what happens with credit in terms of, turning that over.
Yeah, I feel like I've been saying for a while, it all depends on how I spend my money this year, like if I'm indicative of what the consumer is doing. Kriti, where I think that this point also matches is with Fastenal. So that is basically a company that sells industrial construction supplies and products, right? So it's sort of a lead indicator of industrials. Their sales are still okay in March, but they're slipping versus Delta that's seeing strong demand out 6 months. I wonder if this is just what it is, like the narrow leadership, consumer exposure, you're good, otherwise it's going to be tough.
Well, you are already kind of seeing that, right? And even on a sector basis, I mean, kind of zoom out, take a 60,000-foot view, you're already seeing that with the kind of staples outperforming discretionary. That's an easy trade to say, well, look, people are actually bracing for some sort of recession. I want to go back to the point that Guy just made about credit crunches, actually, because it's a fair point about how much of the tightening of lending standards is going to kind of do the job of the Federal Reserve for it. But let me make the opposite point. You're doing this 2 years out from extraordinary years of debt issuance. A lot of these S&P 500 companies had record issuance, record equity issuance and debt issuance, including, by the way, oil companies, which were kind of taken out of the market or not allowed to even access debt and capital markets for a very long time. And yet here they are sitting on these record piles of cash. So I think a lot of that kind of carries over several years because they still have that cash on their balance sheet. So even if you do see that tightening of lending standards or that kind of tightening of debt issuance or whatever that might be, that credit crunch, there is a cushion built in as a function of easy lending post-COVID.
I think your point is well made. Transmission is taking longer. Maybe we short-circuit a little bit of that with what is happening with bank lending standards. Ed, final question to you. Can the Fed cut rates with the consumer as buoyant as the consumer appears to be?
Yeah, that's the $50,000 question, and my answer is no, they can't do that. When you look at the Fed funds futures, they're pricing in basically 90 basis points of cutting from May to January of next year. That's not going to happen except in a case where you have one, inflation coming down, almost to the 2% target, and 2, the consumer buckling in a massive way into a deep recession. So the yield curve is very difficult, especially for high duration equities. I think that we've seen a rebound into high duration, and I think that that's premature, especially given what you see the bond market saying. That's only going to happen in a very negative scenario, and that's not good for earnings, obviously.
Right. And the point is, if you cut and the consumer's strong, they're going to go spend more. So there you go. All right, guys, thanks a lot. Really fun conversation to kick off the 2 hours. Kriti Gupta and Edward Harrison joining us from Bloomberg. So coming up, we're going to take you to the World Bank IMF spring meetings in D.C., where we're going to have an interview with Pascal Donahoe, Eurogroup president. So stay tuned for that. This is Bloomberg.
Surveillance is live from Washington, D.C. as part of Bloomberg's extended daily coverage of the World Bank Group and International Monetary Fund's spring meetings.
These meetings, even with the banking crisis in place, are really, really important.
Economic outlook, poverty eradication, aid effectiveness, and more.
How slow could global growth get?
You could have a global recession. Live coverage throughout the day continues all week on Bloomberg, your global business authority.
I believe we can get inflation under control, but I don't underestimate the challenge, because just as in the United States and the EU, core inflation, underlying inflation, is still between 4 and 6%. So there's still a lot of work to do.
That was UK Chancellor Jeremy Hunt speaking with Maria Tadeo at the IMF in Washington yesterday. Now Maria joins us again with Eurogroup President Pascal Donahoe. Maria?
Yes, and good morning, obviously, from the IMF. Very good to see you, obviously, Mr. Donoghue. Is always excellent and busy every time we see each other. But I do have to ask you, my impression, and granted we've been here for 48 hours, but the IMF paints a very gloomy picture for the global economy. When you look at Europe, obviously the data changes a lot depending on the country, but they say the risks are very much tilted to the downside. Are you feeling gloomy yourself?
So I'm naturally optimistic and always believe in the ability to make progress, despite all the challenges that, of course, the IMF are correct to identify. And of course, you are right in your question that the IMF have made a number of modifications to the growth outlook of a number of European countries. But the bigger picture that I would argue for is, even with the changes they have made in growth forecasts, they are still forecasting growth for the euro area and for the European Union. And I think that bigger picture of economic growth still happening in 2023, still taking place in 2024, for me is the broader assessment of where we are, because it is, after all, in Europe that the war is at its most intense.
And you make a very good point. When you look at the numbers, maybe not a lot has changed. To me, what is fascinating here is just the tone of the language that the IMF used. Again, seeing it is all to the downside. The risks are very much to the downside. Do you fear perhaps that there's too much negativity going on here? You're talking down perhaps the economy, or actually you believe they have a point? A lot of things could go wrong, and if they all do, then we may be in trouble again. It's very bumpy.
I think the IMF are acknowledging the reality of where we are.
Which is war?
It is an exceptionally complex policy environment. And in the World Economic Outlook, I think the analogy they used is that the fog is thickening, that policymakers have a narrow path ahead of them to manage the competing demands of dealing with inflation while still trying to maintain a degree of economic growth. And I think they're right in that assessment. And certainly within the euro area, we are very much aware of, for this year and next year, regarding the need for fiscal policy to play its role in getting inflation down, while at the same time, as finance ministers, we still want to maintain the level of employment that we have in our economies and try to sustain a level of economic growth. But I go back to the point I made earlier on. For me, what is still very positive is, despite that narrow path that we know is there, the IMF are still acknowledging that our economies will grow this year and next year, and grew last year by more than many would have expected.
And of course, many would say the IMF projections many times tend to be wrong. So we'll see at the end of the year who was right on this front.
I am sure, Maria, when you have been quizzing many of my colleagues here in this chair over the last day, they have been saying back to you, yeah, the IMF forecasts are important, but we're confident that we will do better than them.
And that's obviously what you say too. But I want to ask you, though, when you look at the specific indicators, you mentioned there's a lot going on. You can look at GDP, you can look at inflation, you can look at employment. But the real focus in Europe, once again, seems to be the inflation print. And there's this very, it's a fascinating intellectual debate, but it's very complex. This idea that headline inflation, it is coming down, and that's the actual target of close to 2%. But core inflation may be sticky. And this is a new playbook for central banks. Do you believe, and Madame Lagarde was here, I know you were in a meeting with her yesterday, that they can get it right?
Yes, I do.
You believe she can get it right?
I do, but I believe we all have our role to play in it. As vital as the role of the ECB is, and monetary policy is in getting inflation down, I'm confident we will get inflation back to where we want it to be, but it's a project and a task that we all have to play our part in. And it's why the case the Eurogroup has been making in our recent meetings is 2023 and 2024 do need to be years of transition, and we need to ensure that fiscal policy isn't boosting demand exactly at the time in which we're trying to get inflation down.
And is that, I know obviously maybe you won't reveal your private conversations with Madame Lagarde. I know she was, well, she's here today. She was also here yesterday, and I know there was a meeting with European policymakers. So in this meeting, not to get into too much of the detail, but did you share the same message? Is that what she also suggested? The fiscal part has to play a role, and then we will get back to target?
Actually, we've been saying in private much the same as we've been saying in public
There's
as
no
well.
gap
Actually.
between what you're saying?
Very little gap. I mean, what we are acknowledging here is the composition of inflation is showing some signs of changing.
Yes.
Positively, what we are seeing is very high levels of energy-led inflation are beginning to come down, and that's a huge positive given how demanding it was a year ago. But it's also the case that we are seeing other elements in the inflation basket continue to be high and higher than we would want.
And the ECB will continue to hike rates. That's what it seems.
And they have indicated that meeting by meeting they will respond back to the evidence, which is why from a fiscal point of view, what finance ministers need to be aware of is not making our challenges more difficult, but also being very alert and very vigilant to second round effects, to third round effects, to decisions that we make from a wage setting perspective and how they could add to that challenge, or more optimistically, how it might accelerate our ability to get inflation down.
And to make it even more complex, you also have to, well, bring in the trade conversation, which to me, it's funny because on the one hand, it is very palpable here that tensions between the EU and the UK are majorly going down, and everyone wants to have a good trade relationship now. But then obviously when you look at China, there is now a big conversation here about what do you do with a country that is so important? You can't decouple, but clearly there's many challenges with China. Would you say it's a friend to the EU?
Oh, look, I mean, and it's been a big theme of the IMF analysis so far in this meeting. They've acknowledged what fragmentation could do, in other words, decreases in trade cooperation, what that could do to our economic outlook. But again, you've made the point there, and it's really true, I just want to endorse it, that in the environment now of the Windsor Framework Agreement being in place with the United Kingdom, as we see the Chancellor, Jeremy Hunt.
Do you like the Prime Minister and Jeremy Hunt?
Well,
do you feel it's a big change from the previous government?
Oh, well, I've had the privilege of working with Rishi Sunak when he was Chancellor of the Exchequer.
He's sensible,
on a personal level, of course, I have the highest of respect for all of the individuals and for the work that they do.
You're Irish, so that's a big endorsement.
And because I'm Irish, it's even easier to be so positive about them because of how close the relationship is between the UK and Ireland. But it goes beyond personality. It goes into the policy choices that we're all taking. And it is the case that because the United Kingdom and the European Union have now worked so hard to come to the Windsor Framework Agreement, President Biden, as you know, is in Ireland at the moment, endorsing the case for that kind of cooperation. We really hope that this will open up the space now for the UK and the EU to find new ways and positive ways of working
and you
together
can really feel
in
it
other areas.
It's a very different
And we all want to play our part in making that happen.
And Mr. Donoghue, just very final question. Will there be a communique by the end of the session? There has been multiple reports, including Bloomberg, that once again Russia will say we don't want any reference to the war. The war is going on. We know that people are dying, and they have been doing it for a year. This is happening in Europe, and China will possibly stay on the sidelines. We don't want to comment on it either.
I hope there would be a communique.
You think there will be?
As I said, I hope there will be. But what is more important for me is that we have a communique that is honest and that reflects what is going on in the world at the moment, and that we acknowledge that there's an unprovoked war of aggression happening
If there's no reference to the war, you say ditch it. It's better not to get a communique.
Well, I will leave all of that in the capable hands of Nadia Calvino and all who are working on this in the IMF. This has been a contentious issue in the past. What's more important for me from a national perspective is we have a communique that honestly reflects what is happening at the moment. And I know a lot of work is going on with regard to that today.
And obviously we'll keep an eye on that. Mr. Donoghue, thank you so much for joining us, Bloomberg, from the IMF. And obviously speaking of the UK, we'll go back to Guy in London.
Maria, Very nice. Thank you very much indeed. Regards to the Minister, Maria Tadeo, joining us from Washington, D.C. Maria's not done yet. She has many more conversations still to have. She's going to be joined by ECB Governing Council member Governor Shimkus. That is going to be taking place tomorrow in the European close, 11:45 New York time. Still ahead, what do we need to talk about? Amazon CEO outlining the path ahead for the retail giant, the tech giant, as the industry grapples with mass layoffs. Details next. The startup is coming up. This is Bloomberg.
Great questions.
It's 23 past 7 on the West Coast. Want to get to the startup? We cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Caroline Hyde. I want to start with the Amazon's letter to shareholders. This is the second from Andy Jassy. What did we learn? What are some big takeaways?
That they're still investing. Look, he says the sad fact of the matter, they're letting go 27,000 corporate jobs. And look, they continue to reevaluate whether they need to double down on that or not. But really, the focus is still there. Throughout its lifespan, it's always double down on investment within the company. Even in times of 2008, he mentioned, of course, various other macro headwind periods of history. So at the moment, the areas of growth still remain grocery in particular. Just think Amazon Fresh. They haven't quite worked out how to expand that, but they're still thinking about grocery. They're still thinking about satellites and the way in which that we can access the internet. They think that's a big area to leverage. But really, this is a company that says there is still so much more for the taking, whether it's in terms of commerce, which still 90% of it is done in store.
Caroline, there's a big one you've missed off the list there, so let me take you straight to it. Exactly. AI.
All aboard the generative AI train. And in a way, the letter was trying to make out that, look, for years, for decades, they've been into machine learning. And they have, to be fair. AWS has been offering machine learning capabilities. They've been really investing and creating their own chips to give to their clients to make sure that that compute power isn't completely out of their price range. Now they're giving us not one but two large language models. Titan is the nice name of this particular one, but look, they're not actually chatbots, guys. So it's not some ChatGPT. This is more about creating text, and it's also about making your shopping experience just that much more predictive, it would seem.
Right, so it's all about buying more stuff.
Yeah.
You know, that is always what it's about for Amazon. Just honing on the grocery part for a second, because that hasn't necessarily been a particularly successful part for Amazon. What are they saying about that?
Yeah, I think they admitted really that they haven't quite got it right yet. And the fact that Whole Foods, they still feel they've got a big presence that they can leverage. They want to, and all of this is about
about making things more cost effective. So a lot of the letter is dedicated to how they can ensure they got the right product in the right area for you, whether that's investing in their warehousing, but then this is more about how can we offer you the right grocery package at the right price point. At the moment, I think it feels as though they're still investing, but they haven't worked out the way in which that's going to work for you and I, because you're right, the way in which I buy, I'm always confused. Is it Amazon Fresh? Is it not Amazon Fresh?
Totally.
So I think they're still looking at that particular marketing area and whether they've really landed on the right name, the right price point and the right offering.
Yep, still not there. Groceries are confusing. Certainly for me. Caroline, thank you very much indeed. Caroline Hyde, you can obviously dive deeper into this Amazon story. We're going to be talking to Amazon Web Services CEO, a guest at 2 p.m. New York time. This is Bloomberg.
We're about an hour into the U.S. trading session. Some earnings trickling out here. We are around the highs. Kriti Gupta is tracking the moves for us. Kriti?
Yeah, a little bit of green on screen, Alex. The S&P 500 higher by about 0.7%. Seeing a little tech outperformance there. NASDAQ 100 higher by about 1.4%. Seeing a little bit of breadth, and that is a good sign if you were worried about the sustainability of the stock market. Let's take a look at the bond market, though. We're looking at a two-year yield that is below 4%, and I think that's interesting because it was coming up against that 4% level, a key technical level for the two-year yield specifically, and now has kind of retreated, which tells you that technical level is still in play. 393 on that yield. Even if it's a move of just 2 basis points, it matters as we talk about whether or not we're going to see hikes from the Federal Reserve throughout the summer, not just in May. The euro is also pretty interesting. Look, we're seeing weakness in the dollar in favor of the euro. Is this time for Europe to shine? We'll ask Guy Johnson in just a second. 110 on euro dollar here, stronger by about 0.6%. I do want to look at the commodity market here because, again, when we're talking about inflation, of course, oil is going to be at the center of that story. And here's something nobody is talking about. how dangerously close we are getting right back up to $100 oil. I'm not saying we're going to get there, but I am saying we're headed in that direction. We're about 83 handle for NYMEX crude. Now, it's important because for me, Alex, the guy probably can't relate, but when I think about 87, I always kind of round up. Maybe it's 90, maybe it's as close to 100, kind of like you do with birthdays a little bit. But regardless, this is going to be a concern when you talk about inflation throughout the rest of the day. I can't even get into the age conversation. That's a different one.
I definitely round up. It makes me feel better.
Round down. I round down.
I'm in the middle of rounding up. I'm in the middle of rounding up, and I'm about to hit like age 40, and it's terrifying. Anyways, I want to talk about the micro.
Guys. Let's just be very clear. Go ahead.
I want to talk about the micro. Let's talk about the earnings picture here, because we were talking about Delta earlier in the session, coming out with their earnings. Look, the summer bookings are going to be very, very strong. Perhaps their last quarter was not, but that is reversing. That's not a positive thing in this market anymore. Take a look at Delta shares, down 1.7%, and a little bit of a ripple effect throughout the rest of the airlines. American down 0.7 as well, and United higher by 0.2, but pairing a lot of those gains. Guys going to love this little tidbit, because for me, my favorite part of the Delta earnings was they're offloading their cargo operations a little bit, which is interesting. A lot of other airlines did that post-COVID when there was that recovery. Delta held on, and that's kind of now catching up to them in some regard when they're talking about their bottom line. I want to go big picture and end here really with a last board on the airlines broadly. Look at how much pain you're seeing. The sympathy trade is really important, because remember yesterday American Airlines came out and said, look, we're going to front run our earnings a little bit. We're also going to talk about a weak quarter. So you saw Delta collapse a little bit on that news and then take another hit today. And really, it doesn't look like it's recovering. We'll see if it does as we actually get more and more information throughout the next few weeks.
Pretty great stuff. Great roundup for us. Thank you so much. So earnings season, right, officially upon us. We get banks tomorrow. Mike Wilson, Chief U.S. Equity Strategist and Chief Investment Officer at Morgan Stanley, talked to Bloomberg earlier about his expectations.
This earnings season will bring what it's been bringing the whole time. I mean, I don't think it's that different. We're going to see earnings come down again for the second quarter, right? We're going to jump over this lowered bar that has come down by about 7% for the first quarter. That's S&P overall.
I mean, no surprise, he sounded a little bearish, but it does really raise the question of the day. When does the top line tank? I feel like we were waiting for it to tank for the first quarter earnings, and now we're waiting for it, but so far we're not really seeing it. Anastasia Amoroso, iCapital Chief Investment Strategist, says this earnings season is actually going to be better than people think, and she joins us now. Do we get the top line tanking? When do we get it tanking?
Not yet, Alex. The answer is not yet, and the reason is because the economy is not tanking. The economy is cooling, it is slowing, but it's not cratering, and in fact, the opposite has actually happened in the first quarter. I mean, everybody was so bearish coming into this year, and the consensus analyst expectations for GDP growth were 0, or maybe even slightly negative for the first quarter, but instead, at some point, we were tracking 3% GDP growth. Now the latest tracker is 2.2%. So that's a sizable surprise to consensus, and if you think about what drives top line, it's the economic growth. So as long as economic growth is still hanging in there and continues to surprise to the upside, I don't think earnings actually tank. I don't think the top line tanks.
So no recession. Anastasia, good to see you, by the way.
Good to see you. I mean, look, no recession that is imminent. I mean, we all look at the same recession probabilities, and we know the yield curve, and we know, sort of, all the other indicators that suggest that probabilities are rising. But what I really want to say to investors is that it's not yet time to pre-trade a recession. Because when you think about the business cycle, you've got the recession, you've got the earnings, you kind of got the bounce back, you've got the earnings recovery, then you have the Fed tightening, which we're just about to hopefully finish, and that tends to be one of the worst periods in terms of performance for the markets outside of a recession. But once we get through the Fed tightening, what comes next is sort of this relief period, which I think is exactly where we are today, which is we got through 500 basis points of rate increases, and the economy has not yet fallen off a cliff. So I think that period of time, that results in some of the better investment returns for investors, and I don't want to get out of that and miss that, right. Looking for that eventual recession.
Is there a yet that has to happen? Or are we already trading on 2024? Like when we hit the low in October, was that already pricing in the yet, and then now we need to be looking out another 18 months?
That's a really good point, Alex. This is why you kind of look at the market value today and say, well, maybe it's a little bit stretched because the multiple is 17 or 18 times, and how much higher can we get than 4,000 or 4,100 on the S&P? But that's exactly the point. Is if you start looking at the next 12 months worth of estimates, that we're now into 2024, at least partially, and so the next 12 months has risen to 230 versus the number for 2023 that's 222 or 221. So the further we get into the year, Alex, you're right, the more we're going to start trading on 2024. And now, Guy, you're probably going to ask me this, but as in 2024 been not cut down sufficiently, guess what? That 2024 number at some point was something like $275. Today it's closer to 250 to 248. So I would actually say we saw some cuts to even those next year's estimates as well.
I want to talk about Wile E. Coyote for a moment. Wile E. Coyote runs off the cliff and looks at the screen and then drops. So there's a moment where he looks at the screen before he drops. Is that moment where he looks at the screen long enough to get the equity market from one side to the other? Can we look through the gap?
Yeah, that's a great question. I think, luckily we're all sort of anticipating this, and frankly, we've been anticipating this for quite some time. We've all been looking for this next shoe to drop, and I think the reality is we've had time on our side to position the portfolios. I mean, most people have been talking about a recession, honestly, for the last year, so most people have taken steps in their portfolios to de-risk those, and I think the reason why the markets has not really meaningfully traded lower, for example, on the banking crisis last month, is because most people have raised cash. Most people are feeling pretty comfortable getting paid close to 5% in their money market accounts, and we're now also starting to inch back into the bond market as well. So investors have had time on their side to prepare, and if we have that next shoe that drops, if we have the sharp decline in the equity markets, most people are going to find themselves in the position of having cash they need to deploy. So one of the risks that I actually heard from some of our investors is, are we going to get that flush out where we really want to deploy the cash? That's what people are starting to worry about.
Well, is that why we tend to see still a buy the dip scenario for that exact reason?
Yes, I think in some cases, I heard this expression the other day that we went from, being just fine to miss out any sort of, the upside because there wasn't any, to now back to the FOMO. Right. The fear of missing out is back. And I think that's true for some of the tactical investors. I think it's one of the reasons why if we continue to move a little bit higher from current levels, you'll have systematic traders get back into the market. You'll have hedge funds step back in. You might even have mutual funds. But some of the long-term money, let's say family office money, sovereign wealth funds money is looking for a better deal still. They're truly looking for another, 10, 20, 30% declines across asset classes, and that's what we don't seem to be getting just yet.
Yeah, you got all this money sitting in money market accounts. You've got lots of dry powder waiting to be invested, and maybe that just keeps us elevated for much longer than we anticipated. Anastasia, in that kind of scenario, can the Fed cut rates? People are talking about it maybe not being a 2023 scenario anymore. It could be one maybe at the back end of the year in terms of the cuts that are going to be delivered, and then we get lots and lots in 2024. If the consumer keeps going, and I appreciate we've got retail sales tomorrow, can the Fed cut rates?
I think the jury is definitely still out on that, and I'm not in the camp that the Fed has to imminently cut rates because the economy really truly needs to fall apart. And if you look out to consensus estimates, we're looking for sort of flat-ish GDP growth, and I think we really need to see more meaningful downside. So the Fed should, in my opinion, pause after May. They should keep rates around this current level of 5.25%, and as inflation comes down, there is this positive gap that finally opens up, and I think that will give the Fed some slack to cut rates if they need to, but I don't know if they need to, Guy, because if the unemployment rate is 3.5%, if we're still creating a decent number of jobs, guess what's not in a recession? The U.S. consumer is not in a recession. We heard that from Delta, from some of the other airlines, and so as long as the consumer is hanging in there, that prevents the economy from slipping into a recession, and I would not count on the Fed cutting rates.
Great stuff. Anastasia, so good to see you. Thank you for being here. Anastasia Amoroso, iCapital Chief Investment Strategist, joining us. All right, coming up, Tellurian is higher after the news that the U.S. LNG provider landed a $1 billion sale-leaseback deal that would grow its exporting capabilities. Basically, we're going to talk about natural gas globally and what the supply outlook is like and what we can do here in the U.S. to export more. Do we need to? Sharif Suki, Tellurian Executive Chairman and Founder, joins us next. This is Bloomberg.
Keeping you up to date with the news from around the world, here's the first word. I'm Simone Foxman. U.S. producer prices fell in March by the most since the start of the pandemic. The producer price index decreased 0.5% from the previous month. For the year, the PPI rose 2.7%, the smallest gain in more than 2 years. All of this is likely to temper overall inflationary pressures in the coming months. Donald Trump is back in New York today over his legal woes. He's scheduled to be deposed this morning as part of a civil lawsuit by the state, which accuses him of manipulating the value of his assets for years in order to dupe banks and insurers. This will be the second time he's been deposed in the case. In his first deposition last August, Trump pled the fifth, not answering any questions beyond confirming his name. Norway is expelling 15 Russian diplomats suspected of spying. All of them were working at the Russian embassy in Oslo. Russia calls the move another extremely unfriendly step. The foreign ministry says Moscow will respond with similar action. Global news, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Simone Foxman, and this is Bloomberg. Alex.
All right, Simone, thank you so very much. Okay, so let's take a broader look here at the ramifications of the Ukraine war. Europe did make it through the winter. Dutch prices are down 86% from their peak. Yay, good news. Skeptics, though, remain. Total Energy CEO Patrick Pouyanné spoke at the Columbia Global Energy Summit in New York earlier today. He said, quote, I think it was yesterday actually, the idea that Europe has solved the issue is wrong. We have a supply gap. Nevertheless, prices still continue to trade lower. We're going to bring in Sharif Souki, executive chairman and co-founder of Tellurian, one of the companies hoping to build the next generation of LNG export terminals in the U.S. Joins me now on set. Sharif, good to see you.
Alex, always good to see you.
So you were actually at the same conference. I'm looking at Henry Hub, $2. I'm looking at Netherlands gas prices down 86% from their highs. How do we think that the gas prices is not solved?
It's 86% from a ridiculously high price.
Okay.
So we got into a crisis last year that was in the coming 4 years. If you remember, gas prices in Europe went up before the invasion of the Ukraine. So we already had a problem, and all of a sudden it was compounded by the fact that Russia invaded the Ukraine. Nord Stream 1 and Nord Stream 2 were exploded. So even if we think that maybe one day with peace those flows of gas from Russia to Europe could come back, not without rebuilding those pipelines. So right now Europe is missing 15 BCF a day of potential supply coming from Europe, and potentially up to 20 BCF a day. So this is not coming back.
Right. It feels like the problem, and then this goes to the driftwood thing, that you need to find funding, right? Like you need partners, you need contracts, you need the money, right? How do you, yeah, go ahead.
Since you've taken Russia out of the picture now, most of the gas coming to the global markets in the future will come from two places, Qatar and the United States. That is basically it.
But how do you get the funding when cost of capital is going up and gas prices are still low?
So
that's a really tricky spot.
So the first thing that people had to acknowledge and accept is that prices are much different than what they were when I started Cheniere and we built it. So I built Sabine Pass for $600 a ton, and I built Corpus Christi for $750 a ton. And you see in those 2 years already a significant increase in prices. Today, if you think dreaming about less than $1,200 or $1,300 a ton, it's impossible. So people were still stuck on, we're going to do the same thing that Sharif did 10 years ago. No, you can't. Interest rates are higher, inflation is higher, and it is going to cost a lot more money. And also, you are now put a strain on all the construction companies around the world that can actually do this. So if you look at the companies that have gone bankrupt, Kyoto, McDermott, trying to keep up with these kinds of schedule. Today, the numbers of companies that can actually do this is down to one, Bechtel. And you're seeing that all the projects in the United States that have that are moving forward are using Bechtel. Whether 10 years ago you could compete one company versus the other. So you put those two things together. It's more expensive, and there's a shortage of construction companies that can actually deliver. You're going to have to be a lot more careful and accept higher prices. On that basis, in the United States, you have a problem with the fundamental model that we found for America 10 years ago that is no longer valid.
Sharif,
yes.
Good morning. It's Guy in London. So we've got a supply side problem. You're laying that out pretty clearly, and it's going to be one with us, that's going to be with us for quite some time. I want to know about what you see the demand picture looking like, though, over the next 12 months. Europe, as Alex says, has made it through the winter. The United States seems to have a lot of gas. The bit that I still don't understand is what Chinese demand is going to look like. How much gas is China going to need over the next 12 months, and what impact is that going to have on prices?
Well, I mean, the first thing is it's the other way around. How much gas China is going to need depends on what the prices are going to be. So the demand at the moment just to stay in place, replacing Russia with probably about the equivalent of 150 million tons for Europe. Replacing the decline in Asia from the fields that are now starting to mature is another 40 to 50 million tons. So you need 200 million tons just to replace what is now disappeared. So that's about 60% of the market. That's a big challenge in and by itself. China is going to come back, whether they go back to, because they need the energy. They are increasing the number of people in the middle class. You don't come back from that. If you promise somebody that you're going to give them air conditioning because you moved them to a very hot area, you don't after 2 years say, oh, I was kidding, I'm changing my mind. No more air conditioning. Now work at night and sleep during the day.
Okay,
those things don't work.
Okay, so I'm looking forward to next winter. That's the bit that I'm really trying to figure out here. At the moment, we seem to be in a position where we think the gas crisis is behind us. We think that inflation is going to be coming down. We think that the consumer squeeze is starting to abate here in Europe. Are we going to be back to exactly where we were coming into this winter at the beginning of next winter? Because we're going to have even more demand, and as you've laid out, the supply side is going to be limited. Are we done with this gas crisis? We may have a glut right now, but how long is it going to last for?
So for me, the big surprise is how well Europe has accepted the fact that they're going to pay more for everything. So if you're in the middle class in Europe today, your utility bills are up by 25%, and the rest is subsidized by your governments. And your governments are going to subsidize you in Europe to the tune of $300 to $500 billion. That is basically half of the tax revenues for Europe. It's a very, very, very heavy burden. So when we talk about things that have come back down, yes, they have, but utility bills for people at the middle class level are up 25%, and for the higher class, people who can afford it, they've doubled. But you're not going to get much sympathy for somebody who tells you, I can't heat my swimming pool anymore. But the rest is subsidized by the government. So take France, for instance, $60 billion in subsidies for utilities. It's not sustainable.
Right.
How long can you do this? So if we get back to where we were and we have another mild winter, you're still going to have very high utility bills in all of Europe. You've done the easy stuff about deindustrialization. So fertilizers are gone. So people were asking me the last time I was in Europe 2 months ago is why are eggs more expensive? Why is bread more expensive? Because of fertilizers. Without natural gas, you don't make fertilizers. Without fertilizers, you don't produce food.
It's like we don't know when that tipping point is going to come home to roost, but it's still a problem that's going to be roosting. Well, I got to end here, though, Sharif, on your customer base. So, like, how close are you to securing customers? And are they oil majors? Is it India? Is it Japan?
It is not about customers.
For you? For Tellurian.
Yep, it is not about customers. The world is giving you $14, $15 gas prices today, and as you said, America is giving you the gas for $2. That margin is amply sufficient to finance a project. In fact, you get your money back.
Where are you going to get the money?
That is the issue. Okay, so we've just made an announcement on the creative financing deal that somebody came and approached me to. Yeah. Stay tuned. We're going to make another announcement pretty soon. The banks are there for about 50% of the project. So we're now down to looking for the last $1.5 billion or $2 billion. That will happen sometime pretty soon.
Where? How?
Equity partners. So the difference from 2 years ago, that all the energy companies around the world had no money. They were all, BP and Shell cut their dividends. Total and Exxon were thinking about, do we need to do the same thing or not? That's not an issue today.
Who are the equity partners going to be?
It's somebody, I mean...
Are they majors? Are they countries?
No, they're going to be a combination of all of those things, but the template is what ConocoPhillips did in Port Arthur. Yeah. A large energy company making a lot of money for the last 12 months, has stepped up and said, I'm a partner, I would agree to participate in the cost of running the facility and paying the debt service. And then I make my return based on the fact that there's a very large discrepancy between the U.S. and the rest of the world.
We got to go, unfortunately. We could talk forever. Sri Suki of Tellurian, thanks so much for joining us. This is Bloomberg.
Quick market check out of Europe. Stock 600 up, luxury is up, utilities are down. Luxury is being driven by LVMH, are up by 5%, but this is the story. Euro dollar north of 110, 110.47. The European closes next. We're going to be joined by Ben Ritchie. This is Bloomberg.
About that all day yesterday.
Thursday, the 13th of April. European equities are looking pretty good today, but actually, truth be told, its French equities are looking good today. The luxury sector is up very strongly. The CAC 40 is up very strongly. It's down to LVMH, 52-week high after 52-week high. They continue today. We get Hermes tomorrow. Europe is being lifted by that story, but it's a story about a strong consumer. We're going to talk more about that in a moment. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So let's talk about European equities. European equities are being driven higher by the luxury sector. We're up by 0.3%. The stock 600 is trading at 463.79. We've got a strong euro, which is interesting. Is that a tailwind or is that a headwind for European equities? At the moment, we're definitely kind of bottom up. We're focusing on the earnings story and what's happening with management. Leonardo out of Italy. The Meloni government is shuffling the deck chairs in terms of management. The market likes that story from a Leonardo point of view. Still like Finmeccanica as a name, but we'll go with Leonardo. That stock up by 3.2%. Novo Nordisk, this huge diabetes giant that has done so well of treating diabetes, continues down the obesity line. Wegovy, the drug that it is doing so well with right now, is turning out to be even better than anticipated. That stock up on the back of that one. Novo Nordisk and LVMH, these are two real heavyweights out of Europe, Alex. You get decent numbers being generated and decent guidance being generated by these kinds of companies. Europe is going to creep higher and higher in terms of the equity position.
Yep, and here in the U.S., it's part of that, and then it's also still some perplexing parts of that. So if we talk about earnings, it really does feel like it's going to be a bottom-up kind of scenario over the next few weeks. Headline level, S&P up 0.6%. You could attribute that part to the PPI kind of slowing, producer price index slowing a bit in March. But then if we dig a little deeper into the micro, so Delta actually had a really good forecast for the second quarter and for the summer travel season. That top line really holding up. We did have a nice pop in the stock, up 3%, and we're now a bit lower, down over 1%. We'll talk about that later on in the hour. So that's more the consumer, what are we buying and spending stuff on. Now, Fastenal is a little bit different. This is an earlier read. It supplies the industrials. It's an early read on some of the industrial guys, and they're seeing sales slow and moderate a bit in March. So that's not getting hit, down 3%. So that feels like a really good look at the micro story for earnings. Exposure to the consumer, certain type of consumer doing well. Everything else, manufacturing, industrials, we know it's going to get a little bit of hurt. Well, that's rolling over a little bit on the top line. And I just want to point out here gold, and this is obviously going to be a dollar story, weaker dollar, good for gold, but we're like 15 bucks away from a record high. I'm just putting that out there. Like, is that a money market thing? Like, are we going to gold because you're taking it out of a bank? Yep. Like, what is that?
I don't know, but it has been it's been an amazing run. I would argue you take a look at silver for something even more sensational. Alex makes a really good point. The top line is continuing to form. She brings up Delta. That Delta story, I think, is emblematic of what is happening here. Delta's top line looks okay. Maybe there was a slight miss, but expectations were high. But it's the middle of the P&L where the problem lies, and that is leading to a bottom line, which is a little trickier. But the signal here is maybe that actually the consumer is still continuing to do very well. We are getting into the earnings season. What is that earnings season going to deliver for us? We get ASML on the chip front. Next we get Heineken, we get Nokia, we get SAP. A real mix of stocks there. Heineken could be interesting on the consumer front. What is happening on chips, I think, has been a well-telegraphed story, Alex. But we are definitely into earnings. Is it going to be a top line versus bottom line story, which I think is fascinating?
Yeah, and we have the season really picking up full swing tomorrow in the U.S. You got the global economy, though, still recovering from that pandemic. So Dominic Costum, Mizuho America's head of macro strategy, he spoke earlier on Bloomberg Television about that macro outlook.
Whereas one of the problems with COVID was economic scarring. The fact that if you take out the supply side excessively, then you end up with a much worse inflation growth trade-off down the road. So you don't want to really scar the economy, which will have a much longer-term implications for for productivity and a good inflation growth trade-off.
Dom Costum talking to a little bit earlier. Our question of the day: when does the top line tank? Which is basically a question around when does the recession hit. The consumer at the moment looks fairly good. I appreciate we get retail sales tomorrow out of the United States, which is going to be fascinating. Let's answer that question maybe from a European perspective, a global perspective. Simon White, Justina Lee joining me now here on set. Justina, I keep looking at the numbers. I keep being confounded by how the consumer is holding up. It's another earnings season when we thought we may take a hit. It's not happening. Delta, I think, is really interesting. It's basically saying if you're looking for a slowdown, don't look here.
Yeah, it's pretty interesting because if you look at numbers like the consumer sentiment in the U.S., obviously that's been worsening. And generally, we've all been talking about a recession, right? But with the numbers kind of coming out of Uniqlo's owner, LVMH, I think what the picture we're getting is that maybe the Chinese consumer can also pick up a bit of the baton here, or maybe the recession hasn't really hit the wallets of consumers most able to spend just yet.
Yeah, which begs the question, Simon, is it the yet part? As in, we're going to get it. It's just a matter of when. The timing is just off when that top line really starts to roll over. Or do we avoid the yet and we're trading off of 2024 rather than the yet part?
Yeah, I mean, it's a very, very good question. I mean, been a very strange cycle, to say the least. People coming back online at different times. The China thing is a very, key point. The loan demand in China has risen sharply. The household sector was heavily repressed through the pandemic. In the US, in Europe as well, we supported the consumer. There, they supported the SOE sector and repressed the household sector. Now the household sector is coming back, and you're seeing that in loan demand and in loan growth. So that's a real powerful kind of driver. When it comes to the equity markets, both Europe and the US are now basically just being driven by revenues. So, margins and multiples, which were previously helping drive returns, are now not driving returns, and it's all about revenues. Now, when revenues roll over is based on when leading data, so when the overall economy rolls over, and that's what the data is telling us it's going to happen in the 6 to 9 months sort of time, or even earlier when it comes to the US. But if in that time, of course, if say multiples or margins start to pick up, then maybe when revenues start to fall, so you don't get the huge big decline in equities that you might otherwise expect.
Equity investors are by nature optimistic people. Is there the possibility happening here? We were talking about this in the last hour. Wile E. Coyote runs off the cliff. Wile E. Coyote is the equity market here. The equity market, the economy tanks in the meantime, but the equity market's already looking through to the other side, and Wile E. Coyote makes it to the other side of the valley. Will investor psychology, does it have the potential to make that happen? We just ignore the downturn and we look for the upturn, and we're there already.
This is quite possible. I mean, I'm looking at a lot of price-based signals. Now, the beauty of them is that they don't pay attention to anything else other than the price. You can look at their track record, and some of them are beginning to be like very, very constructive. And remember about equity markets, they're kind of anti-utilitarian. They want to cause the maximum amount of pain to the most amount of people. And kind of right now, it's very easy to have a litany of reasons why equity should be lower. But they might just do the opposite to cause this problem for everyone else and upsetting everyone else and leaving people wondering what the heck's going on.
So, Justina, here in the U.S., we're very much looking at a certain type of consumer helping to support certain type of stocks. Is it the same conversation over in Europe, or is it a bit different?
Yeah, I think kind of what's been interesting to look at what's happened to European luxury stocks is that they're trading at an increasingly wide premium to the rest of the market. And in Europe, they're almost like a kind of growth stock in that you expect, the likes of LVMH to do pretty well regardless of where the economic cycle goes. And I think their latest number kind of really attests to that. I mean, obviously, they're benefiting from the rebound of the Chinese consumer, but at the same time, it's also a very particular sector of consumers, right, that can kind of afford to buy those kinds of bags. And that's really what's driving a lot of these luxury stocks.
But let's go to the other end of the spectrum. You take a look at the grocers out of the UK. Tesco out with numbers today. Top line, still cracking on. Top line's still there. People are spending money, and they are confounding expectations on that front. So the top line is still being driven. To Simon's point, it's the middle of the P&L where the pain is being felt because they're having to pay their suppliers more, and therefore the bottom line hurts. But the consumer is still there. Even at the grocery level, we are still seeing that top line moving.
Yeah, that's interesting. I mean, I guess it could be driven by potentially some increase in nominal incomes as well. And it's kind of funny because if you look at what analysts are expecting, for instance, I mean, we're still expecting like a 8% drop in consensus earnings per share for S&P 500 companies, and people are definitely getting more pessimistic about margins. But I think a big question here is, we've heard about all these companies trying to cut costs, tech companies laying off tens of thousands of employees. So are we going to start seeing those margins stabilize as those kind of cost-cutting measures take effect?
A really good conversation, guys. I think it's going to be super interesting the next couple weeks. Justina, Simon, thank you both very much. So coming up, we'll get more on the question of the day. When does the top line tank? Does it have to? With Ben Ritchie, Aberdeen Head of Developed Markets Equities, who joins us. This is Bloomberg.
Europe derives more than 8% of revenue from China. So in terms of revenue, from a revenue point of view, it's the second highest after Asia Pacific, and hence it stands to benefit when that China reopening, takes place in a more meaningful way, and that's what we're really seeing playing out in the numbers.
Nika Gupta, WisdomTree Director of Research, speaking on Bloomberg Television a little earlier this morning, talking about the China trade, talking about what's happening by extension with the luxury stocks. Let's get back to our question of the day. When does the top line tank? At the moment, as we've just been hearing, the market seems to be very much focusing on the revenue line. Clearly, we are seeing an ongoing margin squeeze, but does that start to ease from here? And what are the implications, therefore, for the bottom line profitability? Ben Ritchie, Aberdeen Head of Developed Market Equities, joining us now on set. Ben, we have focused on the top line, and the top line has been surprisingly resilient, but we've all known about this kind of margin squeeze that many companies have been experiencing. Are we about to get into a position where maybe top line does roll off, but margins, as Simon White was just saying, actually improve and therefore compensate for that revenue decline?
Yeah, I think it's going to be really interesting. I think 23 and into 24, we're going to see a big bifurcation between winners and losers on margins, because the companies that can hold revenues and see their costs fall away are going to maybe really surprise on margins. And we were talking earlier about Volvo Trucks that had results the other day, coming in with almost record margins in the Q1 as they saw supply chains and costs ease and able to pass through prices at the same time. So I think the more concentrated industries, companies with better pricing power could really surprise. I think for others, they might find it more difficult as volumes are falling and input costs are coming up. So I think stock selection is going to be really key.
I mean, here in the U.S., you just look at Delta versus American Airlines, but both are seeing strong demand on the top line, but it's really the difference in how they're dealing with costs that affected the way that their quarter is going to play out. Do we rely on the consumer globally, though, to support the top line, Ben, or does that have to roll over?
Well, I think it's going to be a really interesting balance. I mean, we saw the LVMH results last night, which were absolutely stellar overall, but it's telling you a couple of stories. Europe is okay, the US looking a little bit weaker relative to expectations, and China and Asia continuing to outperform expectations. And I think that might well be the pattern that we're going to see going forward from here. And I think companies with those emerging market footprints, particularly across Asia, maybe in Latin America, might well be able to resist some of the downward draft on volumes and revenues as well.
Does this mean equities have the potential to look through a recession? The top line comes down, but maybe margins compensate. Maybe geographically you have an exposure which allows you to maybe continue to generate decent profitability. Can we look through? Have we already, in some ways, looked through a downturn?
Well, I think history would say in aggregate, no. I think that's probably not likely to happen. But it's really interesting when you look at the financial performance of companies against their share prices. I mean, if you go back to the LVMH example, 2008-9, I think the share price fell 45%. I think earnings were down 2 or 3%. And I think investors have learned something from that. And they've seen companies that have been able to perform through what have been pretty choppy times over the last 3 or 4 years. I think they're going to stick with the winners. For the companies that find it more difficult, I think they will underperform, and you will see that real balance.
So when it comes to the overall European equity market, though, say versus the U.S., the U.S. had a harder low in October, but Europe had a better bounce. And at least here in the U.S., you have to wonder if we're trading on those 2024 growth expectations. Can we say the same thing for Europe, considering the outperformance?
Well, I think you've got to put it into context, Alex, because Europe's outperformed for about 5 minutes in about 15 years
100% true.
of US outperformance. And if you think about the massive outflows, I think we've seen something like 30% of the assets held by international investors in Europe disappear over the last 4 or 5 years. So there's huge potential for flows to come back into Europe. And I think you've got undervaluation as well, and you've got companies that are generally performing pretty well. And when you put all that together, I think that makes for a pretty decent backdrop for European stocks.
Euro just went through 110. People are talking about 115. Is that a headwind or is that a tailwind?
Well, I think it's always a balance, right? So normally when the euro is collapsing, good news for earnings, but probably bad news for sentiment and multiples. I think overall, in the long run, probably doesn't make too much difference. Europe generally benefits from an earnings perspective from a weaker euro. But I think it would be good perhaps to see that stronger euro as a sign of confidence and flows coming back into the market. And that gives you an opportunity for that PE overall for the market to re-rate. And again, we know that European companies generally trade at big discounts to their US peers, and that closure would be worth way more than whatever we'd lose on currency on earnings.
Ben, if the ECB continues to hike while the Fed does one more and pauses, do you still like European equity?
Yeah, I think the ECB is about setting out its credentials as an inflation fighter. It's probably likely to continue to raise interest rates longer and later than the Fed. But I think we're going to start to see the economy globally start to slow. We probably will see the ECB pause. It probably might represent a modest headwind. But I think overall, again, I think for European corporates, I think they're in pretty good shape. And I think the opportunity for flows and multiples to support them is pretty attractive.
Let's segment the market from a market cap point of view. We've talked about some of the mega caps, LVMH, Volvo, some of these big names. What about smaller cap stocks? As we see maybe rates going up, as we see banks tightening lending standards, credit becomes tighter, does that disproportionately affect, it should disproportionately affect smaller cap stocks? Is that already in the price or is there more still to come?
Well, I think traditionally it's quite interesting. When you look at the data, it suggests you want to buy stocks in the small cap part of the market as the recession hits. So if you're waiting for that to wash through, you're going to be too late to take advantage of that. So depending on where you see that, we would think that now is a good time to be thinking about those smaller companies. Again, are they that dependent on credit? Probably not, particularly the listed ones. And those with strong balance sheets, all the good credentials that we talked about, we think this might be an interesting time to think about smaller companies globally, really.
Wow, okay. Sector-wise, what do you like the best right now?
Yeah, again, I think it's really looking for that balance on resilience. And I think it's been that challenge that investors have had to wrestle with over the last 18 months between rising interest rates, rising real rates, but also concerns about the sustainability of earnings. We would probably prefer to have secure levels of earnings. And that's taking us to those companies in luxury, in tech, in consumer staples, in pharma, in businesses where we've got good visibility, good margin defense, good pricing. We think those things are all really important, likely to be more important going forward as well. So those are the areas which we're quite enthused about.
Ben, really nice to catch up. Thanks for dropping in to see us. We really appreciate it. Ben Ritchie, Aberdeen Head of European Equities. Coming up, the latest GDP numbers out of the UK that show that Britain's economy is stagnating. A winter of strikes certainly doing some damage. Details next. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Simone Foxman. Shares of LVMH soared to a record today in France. The parent of Louis Vuitton, Dior, and dozens of other luxury brands saw strong growth in Asia as Chinese shoppers bounce back from a strict COVID lockdown. Still, LVMH is seeing a slowdown in U.S. sales. Apple's accelerating the move beyond China when it comes to manufacturing. Bloomberg's learned that more than $7 billion of iPhones were assembled in India in this last fiscal year, tripling production. Apple now makes almost 7% of its iPhones in India. Shares of Tesco rose today to their highest since last May. The UK's largest supermarket operator posted full-year profit that matched estimates. Tesco says profit probably won't change much into this year due to inflation. The chain calls it the most competitive it's ever been for customers. And that's the latest Business Flash. Guy.
Simone, thank you very much indeed. Let's stay in the UK. UK GDP data out a little earlier showing the economy unexpectedly stalled in February. Basically, it's down to strikes having a massive impact on public services. We are past the point of the pandemic, but the economy maybe not doing quite as well as we'd hoped that it would be. Let's talk about this a little bit more. Lucy White, Bloomberg's UK economy reporter, joins us now. Am I being a little overly pessimistic there? Could this have been worse?
Well, it certainly could have been better. I mean, as you said, we were expecting a 0.1% rise in February in GDP, and obviously the flat line was less than we'd hoped. But at the same time, we did see January's figures revised up from 0.3% to 0.4%, and there was some, interesting figures in the underlying measures. So, for example, retail spending, the retail sector GDP was up by 0.4%, which gives some indication of how households are actually feeling. I mean, as you said, the main drags were from the services sector, and specifically the strikes in education and in the civil service.
Lucy, what's the read-through here for the BOE on this?
It's going to give a bit of a headache, I think. As I actually just came off a webinar with Hugh Pill, the Bank of England's chief economist, and he was sort of trying to, put across some of the trouble that the Bank of England is having. It's obviously we've seen wages, soaring, and he said that there are some signs that those wage pressures are beginning to moderate, but it's still not quite enough to, he's worried that it's getting stuck now, and that wage pressures are actually going to be, driving domestic inflation.
The UK probably has one of the most difficult positions on inflation out there, certainly in the major economies. We're all watching, though, to see what credit conditions are going to do going forward. We've obviously seen the impact of the banking crisis in the United States. We're going to get the big banks reporting numbers tomorrow. We're going to start that process. We got the quarterly credit conditions survey out of the UK today. What is it telling us at the moment about what credit conditions look like?
Well, as you said, inflation in the UK is currently at 10.4%, which is, more than 5 times higher than the Bank of England's target. And there are sort of signs that is beginning to feed through into tighter credit conditions. The credit conditions survey that came out this morning for Q1 showed that defaults were beginning to rise in mortgage lending and in unsecured lending to households. And there were signs that that lenders are, starting to tighten their lending criteria and will be lending less over the second quarter of the year. So, for the housing market, which has currently remained more buoyant than we might have expected, it perhaps gives an indication that there's still a bit of shakiness on the horizon.
So we kind of got through some of the dicier stuff, right? What are we going to be paying attention to next week? What's going to be the next catalyst on the economy for the BOE here?
It's we've got wage data next week and inflation data next week. So, the Bank of England is going to be watching particularly closely on the wage data to make sure that there isn't, that continuing rise in wages. Whether that starts to moderate or whether, like Hugh Pill is concerned, it might actually prove to be stickier than we thought.
Lucy, great stuff. Fantastic as ever. Thank you very much indeed for joining us on set. Bloomberg's Lucy White on what is happening with the UK economy. I'm going to continue the theme with the pre-close. Last orders, HSBC upgrading UK house builders today, a whole bunch of them. Barratt Development, certainly one of those names. Basically what it is saying is that the downturn is already priced in to many of these stocks, though you are seeing obviously continued restrictions in the mortgage space. So it's got a buy on that stock. Let's take a quick look at Novo Nordisk. Wegovy, the obesity drug, doing very, very well. That stock over the last couple of days up by 3.27%. Lots of 52-week highs in the luxury sector. The close is next.